Hi, this is Umar. This is part of our option trading tutorial where we explain various option strategies and its adjustment. Few days back we did a video about short straddle adjustment. You can check the details of the video on the above link. It is going to appear somewhere here. In today's video we will discuss one more option strategy, adjustment strategy for short straddle. So if you don't know what is straddle, I'm just going to give you a small briefing what is short straddle. So when you sell at the money call and at the money put on the same expiration and on the same strike, it is going to be a short straddle, right? So you expect the market to be range bound and you don't want the market to be very violent or volatile so that you enjoy the profit from the time decay. That is short straddle. Yeah, when we deploy a short straddle, you expect the market to be range bound. You don't want the market to go beyond or past your break even point. That is the point of doing the short straddle. But when the market is very violent or moves, it is going to make trouble on the either side, whichever side it breaks, it is going to be making trouble. If the market is shooting up, the call is going to make trouble, and if the market is crashing, the put is going to make you trouble. So short straddles are good when the market is range bound, but when it moves violently, you will have to do some adjustments so that you exit the trade without any loss, or you exit the trade with some profit. So in this video we will discuss in depth about a short straddle strategy, adjustment strategy, which is going to help. Even if the market is moving violently, you don't have to worry. This strategy is going to help you exit the trade or exit the original straddle which you have implemented with a good profit, or even a small profit. And one more thing when it comes to short straddle is what HNIs or what professional traders do is, for example, if the market is moving higher or market is shooting up, it is moving violently 200 or 300 points, yeah, and that 200 300 points violent move is normal nowadays in Nifty. I can show you days where Nifty has crashed, moved around 450 points in one trading session, and it has moved more than 200 300 points in one trading session. So volatility is there, you cannot do anything about that. What we can do is we can try to manage our position. So back to the point, when it comes to short straddles and when it comes to adjustments, what HNIs or professional trader do is, when the market is moving upside, they will keep on selling more puts, right? That is what is the basic strategy. So when you do this, what will happen is, if the market moves violently and at one stage, if it starts moving or it is staying at one place for some time, that strategy is going to make good profit. But what will happen if the market keeps on moving upwards? For example, let's see in the month of February, if you check the charts, market Nifty moved around 1700 points in 1 month. So that is a good amount of that was a good amount of a good bull rally, right? So market moving 1700 points, how you will adjust a short straddle? Your short straddle will have a break even point of maximum 800 or 700 points, right? But if the market is moving 1700 points, how you will manage the straddle? Normally what professional traders and HNIs do is, as I told you, when the market is moving up, they will keep on adding puts, they will keep on selling puts, or when the market is going down, they will keep on selling calls, so that the puts will compensate the losses will be compensated on the other side. So that is the strategy. In this strategy, what I am going to tell you is a strategy, a type of strategy where even if you don't have extra margin, this strategy is going to help you. If you are restricted with limited margin also, this strategy is going to help you so that you make a good profit or exit the trade without big loss. So that is the objective of the strategy. See, HNIs and professional traders, they don't have any problem about cash. They have unlimited access to cash. But what about the retail traders like you and me? We don't have access to cash, right? We have limited access to cash. We have very limited amount. Maybe we are having 10 lakhs or 15 lakhs or 20 lakhs. With that, we have to do adjustments, whatever we can do. So this strategy is one of that type. So this is going to tell you how you can manage a short straddle if it goes wrong with limited amount of margin money. So that is the main point of this strategy. So these kind of strategies are not available in the market. You cannot find it anywhere. All you can do is help us and support us by subscribing our channel, sharing this video, and also let me know your thoughts in the comment section below, so that I can make more and more informative video about short straddles and other option strategy. So let's go to the short straddle adjustment. So what we will do is we will take the month of February. So as I told you, month of February was super bullish month. Market was going everywhere, like market was super bullish, and it went from 13,700 to around 15,400. I think more than 1,400 points rally. So that would be the ideal time to test our strategy, test our adjustment. You can test, you don't need to test a adjustment strategy when the market is range bound, right? You don't require adjustments in the range bound market. You need adjustments when the market is moving violently. So at the month of February, if you see, Nifty was 1st of February to 25th of February is the date what we are going to test this strategy. And the starting of 1st of February, Nifty spot was around 13,700. So what we are going to do is we are going to deploy a 13,700 straddle, one lot. Yeah, that is going to be our starting point. Already I have sold one call and I am going to sell one put. Yeah, that is a short straddle. So what we have done here is we have sold 13,700 call and 13,700 put, and we have collected a net premium of 53,756. Our break even point on the upper side is 14,400 and on the downside is 13,000. So you are happy if the market doesn't move and is range bound, and if it expires between this range, you are going to make a good profit. But that is not going to happen, because as I told you, February was a super bullish month and Nifty rallied more than 1,400 points. Now now as I told you, we have deployed a straddle strategy. Yeah, we'll see what happens next day. Yeah, the next day I think, on February 1st, Finance Ministry delivered their budget speech, so it was a super bullish day and market rallied like anything. So the thumb rule here is whenever you deployed a short straddle, and whenever the short straddle breaches your break even point either on the downside or upside, you are going to make the adjustment. In our case, what happened is on 1st of February around 3 o'clock, market was super bullish and it already breached our break even point. Yeah, from 13,700 it has come to 14,350. Now what we are going to do is we are going to make an adjustment in this strategy. We are already in loss of around 11,000. So market is around 14,350. What you have to do is you have to go and buy 14,400 one lot. That's what you are going to do. This is the first step of adjustment. Once you do it, on the upside your loss is going to be less. Your maximum loss if market is expiring on around 14,300 is going to be around 20 or 15,000. Yeah, so this is the first step of the adjustment strategy. Next, what you have to do is you have to sell one more straddle. Market is around 14,354. We sold a straddle at 13,700. Market has rallied, market is super bullish, so it has come to 14,350. Now what we will do is we will sell one more straddle, out of the money straddle. So you don't have to worry about this. If what will happen if we sell out of the money straddle or in the money straddle, because if things go strong, it is going to be the straddle is going to make big losses. Yes, obviously it will make losses, but I will tell you what we have to do if thing goes opposite way. So this is how it is going to look like. You have your original straddle, which is 13,700 call, is in the loss of around 28,500, and your 13,700 put, which you sold for 340, is in the profit of 17,300 at the time of adjustment. So your total loss is 11,100. So above that, what we have done is we have bought 14,400 at the money call, and we have sold one more straddle. Apart from the original straddle, 13,700 straddle, we have sold one more straddle, which is the 15,000 straddle. We have sold both call and put. So after doing that, this is how it is going to be. Yeah. So let's see what is happening on the next day. Yeah, market on next day, on 2nd of February, market gapped up and it is rallying. It is going further north. So we don't have to worry about anything as far as our break-even points are breached. So market is rallying. Yeah, market is rallying, super rallying. See, in this case, before we were in a loss of around 11,100. Now we are in a profit of around 2,200. The original call, 13,700 call, is making a loss of around 67,000. But it is compensated by both the put. Yeah, obviously put is going to be out of the money and it is going to make a profit. And the call which we bought when the market was around 14,350 is also making a good profit. 27,000 profit here and 22,000 profit here. That comes to around 50,000 profit. And the second call, 15,000 straddle, which we sold, is also making a profit. The 15,000 call is making a loss of around 12,850, and 15,000 put is making a profit of around 32,197. So this, even in this time, you could have existed, but still we will continue and see what is going to happen. Yeah, market is moving upstairs only. It is not going anywhere. It is only going one side up. Yeah, on 10th of February, this strategy has given a profit of around 5,800. Still we'll see where this goes. This strategy, I will tell you, is going to change the way you are going to trade, because when it comes to adjustment, short straddle adjustment, normally what happens is you will end up requiring lots and lots of margin money. But this kind of strategy is not going to cost you, because the way we have developed and the way we have designed this strategy is with limited margin money also you can make good returns or exit a trade which is making a very big loss. Right? On 16th of February, this trade was in a profit of around 5,800. 5,800, yeah. Still we'll see what happens. You make adjustment only when your break even point is breached. Unless until your break even point is not breached, you are not going to make any adjustment. That is the thumb rule of this strategy. On 18th of February, after doing adjustment, we did adjustment on 2nd of February. As I told, 1st of February was a budget day. Market was very positive and it took the budget very positive and rallied from day 1 of February, month of February. So we are in 19th of February and we'll see what is happening. 19th of February, this straddle is in the profit of around 22,500, and only there are 3 more trading sessions. So we'll see till the end what is going to happen. Yeah, at the end of February series, that is 25th February 2021, this the Nifty finished at around 15,000 and this strategy gave us a profit of around 33,700. Had you not adjusted the original straddle, what will be the scenario? You would have been in a big loss. I will explain. The original straddle, 13,700 straddle, call side you have call side is in the loss of 76,912 and the put side is in the profit of 25,526. Had you not made any adjustment, this straddle would have been in the loss of 50,000, but because we made an adjustment by buying a 14,400 call on 2nd of February, both the original put and the call we made bought to make adjustment is giving a combined profit of around 55,000, plus the additional straddle which we sold, 15,000 straddle which we sold is giving an excellent profit of 53,000. So the combined profit is 33,705. And of course, there are some limitations to this strategy. For example, when the market is moving one side, this strategy will work and this strategy is going to give you a good profit, as I explained. But if the market is making 2-way or 3-way move, this strategy is going to make a loss. So you cannot use one strategy for all kinds of market, right? If the market is moving one way, you will have one strategy, and if the market is moving 2-way or 3-way, you will have another type of strategy. One type of strategy cannot be applied to all kind of market scenario. That is what I'm trying to say. So when the market is moving one side, this strategy is going to help you, and this strategy is going to make you profit, and if not profit, you are going to exit the trade with minimal loss without any extra margin requirements. If you are handling a small trading account or small account, you don't have much money in your account, you can use this strategy. And this strategy, again I'm telling you, this strategy is going to work if the market is one way. If the market is going 2-way or 3-way and the volatility is very high, this strategy is not going to help you. So this is about this strategy. And one more thing I would like to tell you is there is a strong disclaimer. Please consult your financial advisor before trading in options. And I hope you enjoy this video. Thanks for watching. Bye.